Have you been noticing more homes sitting on the market in San Diego County? I've been noticing more sellers starting to reduce their prices, but maybe you are frozen because of the mortgage rates right now. I'm Heather Myers, your go to realtor here in San Diego County, and I follow the housing market so you don't have to. If you are frozen because of those rates, you need to hear what my next guest has to say. I help people buy and sell their homes every day here in San Diego County. And this is something that I want all buyers to know about. Let's get started. Michael Kane from SD Mortgage Couple is here. All right, Michael, let's jump into this topic because there are so many people who say, I would really like to buy a house right now. It looks like the prices aren't going wild like they have been for the past couple of years, but the mortgage rates are too high. So what do you say to people who say that to you?
We have some creative solutions that we've been utilizing for a lot of our buyers here in San Diego. We utilize seller credits to either do a permanent rate buy down to help them kind of absorb some of the costs for the lower rates options, or we do what we prefer actually, or some of our clients prefer, is what's called a temporary rate buy down, where you could use the same amount of credits, but it's going to help to lower your payment significantly more for the first couple years. So the way that a temporary rate buy down works different than a permanent rate buy down. One is you have to get the credits from the seller. So right now I just saw an article that said I think 44% of deals in San Diego are getting seller concessions. So that's what this would be considered, would be a seller concession, where they give you credits to help you kind of ease into the payment. So it's called a 2-1 buy down, where it lowers your payment 2% the first year, 1% the second year. It's not an adjustable rate mortgage. It is a 30-year fixed mortgage, but we're using the temporary buy down to help people kind of ease into the purchase. So say, for example, a $900,000 purchase, approximately, your payment in your first year is going to be about $1,000 lower. And then year two is about $500 lower. So it definitely gives people the opportunity to kind of get used to the payment over a little bit longer time. And then hopefully we refinance them prior to year three of it going up.
Okay, that's what I was going to ask. They're hoping and kind of betting on the rates being lower by that third year and then refinancing into a lower rate. Is that fair to say?
Definitely.
Okay.
We can't promise anything, but what goes up must come down. There are customers that we've done this with last year, and there was a little bit of a refi boom for a month or two. So clients that saw the opportunity did take advantage of it, got out of the 2-1 buy down. Cool thing about the 2-1 buy down that's a little bit different. Any unused amount, you get refunded back, which is unique.
Okay, jump into that a little bit further. What do you mean by unused amount that you get back?
So it's a 2-year program, right? You're buying it down for 2 years. So say year one, there's an opportunity to refinance, and you refinance. So you still would have 1 year that would be unused. Well, that unused portion is reduced from your principal balance. So you're not losing it, where if you were to do a permanent rate buy down and say the market rate was 6.5 and you bought it down to 6, and that cost you, say, $10,000. Now, 1 year into the loan, say, for example, rates were now in the fives and they were refinanced into, like, say, 5.75, they just lost all that money that they invested into invested into buying down the rate permanently. They didn't recoup all their money back. They only saved, $200 a month for 1 year, and then they refinanced into a lower market rate with, a dip in the market.
Even though it had cost them $10,000 up front.
Exactly.
Okay.
So if you do a 2-1 buy down, you're 1 year into it, you refinance, that money's refunded back as a principal reduction. So it doesn't go unused.
Okay, good to know. As far as the cost of refinancing, when people sort of get closer to that third year, what does that look like for people so that way they kind of understand what they're up against cost a little bit down the line?
Yeah, so one, you want to probably work with a lender that's able to give you some credits to absorb the cost. But if you're looking at refinance costs, typically it's a couple $1,000. What those numbers would entail would be like a lender fee is usually about $1,000. Some programs may require an appraisal. Some programs may not require an appraisal. So that's around $500. and then you have to get a new closing company or the title company, and they charge on refinances about another $1,000. So if you add that up together, it's about $2,500. What we like to do for our clients, especially our past clients, is absorb that cost and give them a no-cost refinance by giving them lender credits or parts of our commission to cover that. So they're not losing any money reinvesting into their mortgage. So if rates do come down even further, they're not invested that $2,500, and again, opportunity cost losing that money.
Ah, good to know. Okay, perfect. Okay, so that's
Yeah.
one way. And we're seeing, I mean, even on the real estate end, Michael, just like you said, we're seeing a lot more. We're seeing homes sit. So when buyers go to purchase and to put in their offer, they're able to ask for some of those concessions that you mentioned. And a lot of times they're actually getting them now. We haven't had a market like this in a while.
Definitely, it's great. Uh, People should work with realtors and lenders that know about these programs to offer them a wide variety of products and not just say this is best for you. You definitely want to show the client all the options and say, hey, let's make an educated decision on what's best for your short-term and long-term needs.
Perfect. I love it. Okay, so
Oh.
that talks about a short-term rate buy down, a long-term rate buy down. What other programs are out there that people don't know about or should know about, especially again, when we're seeing homes sit on the market for a longer time, which means desperate sellers who might be more flexible?
So rather than picking a 30-year fixed, I mean, ARM programs are available. We see three-year ARMs, 5-year ARMs, 7-year ARMs. So ARMs do have a bad connotation with the 2008 crash, but these ARMs are different. They're not adjusting, after a short period of time into a volatile market. If you do a 7-year ARM, you're fixed in that rate for 7 years. Your average American is either going to move or refinance in about 50 to 60 months, historically. So, I like a 7-year ARM because it gives you the security of 7 years. A lot can happen in 7 years. Just look back 7 years from now, the whole world's changed almost, it feels like. So I'm an advocate of a 7-year or 5-year ARM for the right customer that, you do have the ability for it to go up, but just like you have the ability for it to go up, it could actually adjust into a lower rate. So, nobody holds a crystal ball, but again, it's like risk reward. So you could save maybe about a 0.5% going into an ARM product, or maybe even a little more. I think it's great because I don't feel most Americans now are in their loans that long. People kind of use it as a stepping stone. Obviously, the Federal Reserve is always adjusting rates up and down. That's done to create movement, to create jobs, and to create opportunities, and have things move, right? If nobody makes money if the market is just stagnant, sitting still. So I think it's right for the right person.
What are the rates looking like on things like some of these 5 and 7 year ARMs?
Um, Today, as of what is it, June 11th, 2025, we're seeing 30-year fixed rates at maybe 6.5 on average if you have great credit and a bigger down payment. So an ARM rate would probably be maybe 5.75, 5.875.
Okay, that's a
So
big difference.
it can make, yeah, it can make a big difference on a $1 million loan here in San Diego.
Yeah, definitely. All right. One of the things I wanted to ask you about, because we hear all sorts of things about these assumable VA loans. They're not super easy to find, but tell us about these loans and who they're available for, the assumable VA loans.
So little known fact, a VA assumable loan can actually be assumed by anybody. You don't have to be a military member or eligible for a VA loan. The downside to the seller or the mortgage holder is that they would give up their VA eligibility while that person holds that loan that assumed it that wasn't a VA member. If a VA assumes a VA's loan, then it transfers and then the seller would have their VA loan available. But that's just a little known fact. The VA assumable process, you're always going to have to work with the seller's bank. So, say the VA loan is held by Chase, that borrower is going to have to work only with, or the seller, the borrower would have to only work with Chase on that. Somebody like myself, an independent mortgage broker, is not allowed to interact or like, qualify that person. So the rules may not all be the same. So it's a little bit of a gray area where I've approved a client, for example, maybe a few months back, and I approved them for maybe $1 million, and then they found a house, I think maybe priced at 800, that had an assumable loan. Well, they found out 60 days into the process that they didn't qualify for that bank's assume that VA lender's loan product. So it was a long process. I've heard stories of these taking as much as 6 months and as little as maybe 2 or 3 in a really good situation. So if the seller's okay, knowing about a little bit longer of a process, it could be a great way to drum up more buyers to your house.
Yeah, you were kind of mentioning some of the downsides on these loans. You mentioned the problem with these can be very, very long escrows. So
Definitely.
that's something that people should keep in mind. You also mentioned that although they are able to be assumed by anybody, if you are the seller with that current assumable VA loan and a non-military member assumes that loan, you lose the ability to use it on your next purchase.
Exactly. So in some instances, it might not matter to the seller, say if their wife was also a VA member and they had their eligibility, or they're buying their forever home and they're buying it cash in a different state or somewhere. So those are instances where it would make sense for somebody, but a millennial or somebody just on their home path that is selling a house and giving up their VA eligibility at a young age, I would think would be a pretty big detriment just because the VA loan is the most flexible and they're going to want that for further purchases in their lifespan.
So once somebody assumes that VA loan, let's say that the sun, moon, and stars line up here, they're able to assume it. What does that typically do, and what does that process look like as far as changing the monthly payment? I mean, there's some like you know fine print here, so to speak.
Well, I mean, it's going to be off the borrower's rate. So if we see people that are assuming loans that were done in 2020 or 2021, you're talking about a rate sometimes as low as like 2.2, 2.1 in some instances. So compared to today's market rates, I mean, that's going to save you, you know, $2,000 possibly, if not more. So that makes a really big difference on your payment. So I mean, if it's available and you find people actually willing to let you assume their loan, whether you're a VA active duty or non-military member, it could help drive your price up because people do really shop on price more, or excuse me, on payment more than price. So if you're able to offer them a lower payment at a higher price point, it's a win-win for the seller and the buyer, which is cool. We don't see a lot of win-win scenarios out there.
No, we definitely don't, not these days. Any questions that people should ask when they're looking at a potential property with an assumable VA loan? Like as a buyer who might not be super educated on the topic, what do they ask?
Um, I would say ask if the seller's really interested in doing that because it could be a way to get a lot of people to your open house. And that seller, may have a VA assumable loan and it's being marketed as, hey, this house is a VA assumable loan, but that seller really might not ever want to do that because they have different restrictions. So, just buyer beware, right? There's a lot of marketing and, promotions and, aggressive realtors that get people to the house to do their job and sell it for the most money. But I've seen instances here in San Diego where it's like, hey, assumable loan, but we went to the seller with an assumable, buyer and they don't want to accept it.
Yeah, so it's not the easiest thing to have to deal with.
Exactly.
What else are you seeing right now going on in the market on your end?
We're seeing a lot of buyers that are just, questioning what's going on with the mortgage rates. Are they going to go up? Are they going to go down? Obviously, we always have the same answer. We don't have a crystal ball. And if I did know, I'd be on a beach trading in Waikiki stocks and, just stacking my portfolio, hedging the market with, knowing the right moves to make. But I can say for doing loans for 15 years, what goes up does come down, and there's always swings in the market. So if you like the house, you could qualify for the house. Use the old cliche, you don't wait to buy real estate, you buy real estate and wait, especially in San Diego.
Ah, well said. That's perfect. In fact, I think we'll leave it at that because as far as getting people some information and some knowledge on exactly how lending works and making sure that they understand, hey, you don't have to go in there with 20% down and assuming that you're going to get a 7% mortgage rate. There are programs out there for people and ideas and creative solutions, especially right now in the market.
Definitely, there's no cookie cutter situation for anybody. So it's always great to look at options and assess what's going to be best for you.
All right, Michael Kane, SD Mortgage Couple. Michael, thanks. How do people get a hold of you?
You can always find us on Instagram, SD Mortgage Couple, at SD Mortgage Couple, or you can give me a call. 619-732-6112 is my local office number, and we're always available.
All right, thanks. Hey, keep up the great work right here in San Diego.
Thank you so much.
And if you have any questions about the San Diego County housing market, or maybe you are looking to buy or sell right now in San Diego County, all of my contact information is in the description of this video and in my bio. By the way, don't forget to hit like or subscribe if you want to know the latest housing market news. Again, I'm Heather Myers, the go-to realtor here in San Diego County, and I follow the housing market so you don't have to.